Hello and welcome to the Lolly Investor Programme. Christmas is almost upon us. People are rushing around looking for presents to buy friends and family. When the shopping frenzy is over, some may even use the holiday period to review their finances and check on their savings. So, with those New Year resolutions in mind, it's time to ask, what should you look for in an investment fund? How do you pick a good fund for your pension or ISA? But first, let's recap on the basics. What is a fund? A fund pools the money of many investors together and allows each individual to invest across a wider range of investments than they could on their own. There are three main types of investment fund. There are unit trusts or open-ended investment companies, investment trusts and exchange-traded funds. To find out more about these, watch the 3 videos I made about them earlier in the series. My following tips apply to all of them. The first step is to narrow down the field because there are thousands of investment funds to choose from. Fortunately, investment funds are divided into sectors. These reflect the asset class and the region they're investing in. A number of investment websites list all the fund sectors and the funds. One of them is Citywire, the publisher of the Lolly. As you can see, there's a range of sectors of funds investing in shares or equities, both in the UK and abroad. There's a similar list for bonds and property. And there are also funds that invest in a mix of these asset classes called mixed asset funds. Fund sectors are like league tables. They help you compare the performance of different funds doing a similar job. For example, if you want to invest in the shares of UK companies, a big sector to look at is UK all companies. Funds in this sector invest in the shares of companies listed on the London Stock Exchange, the UK stock market. There is also a UK smaller companies sector for funds investing in the shares of smaller companies. These funds are higher risk but can deliver higher returns. There is also a UK equity income sector for funds aiming to generate an income for investors from the dividends paid by UK companies. You get similar sectors or league tables for funds investing in Europe, Asia, the US and globally. Once you've chosen a sector, it's time to start thinking about whether you want an actively managed fund or a passively run fund. An actively run fund will be managed by a named individual fund manager. He or she will try to pick the best investments in the sector in order to maximise the returns for investors. A passively run fund will simply aim to track a stock market index such as the FTSE All-Share. Under the hands of a good fund manager, an active fund could beat a tracker, but it will charge more. It's not always possible to tell from a sector league table whether the funds are active or passive, so do bear this in mind as you continue your research. The next step is to look at the sector you've chosen in more detail and pick out some of the funds producing the best returns. Now, we've all seen the small print in investment adverts that says past performance is no guide to the future. Actually, that's not strictly true. In fact, there is some evidence to show that funds that achieve the top quarter of their sectors over a 3 or 5 year period stand a better chance of being top in future. Besides, past performance is all you've got to go on when choosing a fund. The great thing about sector tables like this is that you can compare how much money different funds have made over different periods. Find out if there are any funds producing above average returns over 1 year, 3 years, 5 years and even 10 years if the funds have been going that long. Some websites like Citywire have tools that allow you to analyse the performance of funds in terms of the risk they're taking. You see, professional investors don't just buy the funds that are at the top of their sectors, they look for the funds that are delivering the best risk-adjusted return. The ideal fund is one that will generate a good return with less risk than its rivals. One way of measuring risk-adjusted returns is the Sharpe ratio. A fund with a higher Sharpe ratio is delivering more bang for your buck, as it were. However, you can't avoid all risk, so always invest with at least a 5-year view in mind. Once you've got a short list of funds, your last step is to find out more about them. All investment companies have fact sheets on their funds detailing where they're investing and giving the managers' latest thoughts on the market. Fact sheets are a good source of finding out how funds have performed in separate calendar years. For example, if you can find a fund that falls less than the stock market in bad years and rises faster than its benchmark index when markets are recovering, then you could be onto a winner. Good luck.